Hello everyone and welcome. This video is about things that will change your approach to trading. Today we'll be sharing insights from Jim Simons, the founder of Renaissance Technologies, one of the most successful hedge fund in history. And for those of you who don't know who Jim Simons is, I think the best and quickest explanation is that his returns are far higher than those of Warren Buffett, George Soros, Peter Lynch, and any other successful investor you know. Through his experience, we'll explore several key factors that will help you become a better trader. Okay, so let's start with Jim Simons and his flagship medallion fund. So the average yearly profits of his investment vehicle is 66% during 33 years consistently. I will repeat again, 66% each year on average. So for consecutively 33 years, guys, you can imagine how tough it is for anybody to make such returns. So that is something to be considered. None of the previously mentioned famous people came even close. Warren Buffett and George Soros have around 20% average yearly profit, and Peter Lynch on second place has 29%. So you can see why we are talking about him today. And to give you an idea how big deal this is, imagine if you invested today $100 and you have 66% average return on your money. Then after 30 years, for example, you would have $401 million. And of course, the details of his strategies are kept secret, but from his interviews, for example, and books, we could get some idea how he approaches the market.
Just the kind of thing we did back at IDA. You design an algorithm, you test it out on a computer, does it work, doesn't it work, and so on.
So can we take a look at this? Because I mean, here's a typical graph of some commodity or whatever.
It turns out in the old days, and this is kind of a graph from the old days, commodities or currencies had a tendency to trend. Not necessarily the very light trend you see here, but trending in periods. And if you decided, okay, I'm going to predict today by the average move in the past 20 days, there's 20 days, maybe that would be a good prediction and I'd make some money. And in fact, years ago, such a system would work. Not beautifully, but it would work. So you'd make money, you'd lose money, you'd make money, but this is a year's worth of days, and you'd make a little money during that period. But it was a very vestigial system.
So let's begin. One of the key factors to the fund's success is its focus on quantitative analysis. At Medallion, managers rely heavily on data analysis to make trading decisions. They use, of course, advanced mathematical models and algorithms to find patterns and predict market trends. For example, they might look at the correlation between certain events, such as economic reports or geopolitical developments, and stock price movements. So if they find that there is a reliable correlation, they will use that information to make trading decisions. They use historical data to backtest their models and see how well they would have performed in the past. If a model is not performing well, they will discard it altogether. They don't tweak it. So when there is no reliable correlation which has a higher win ratio on which they can depend, they leave it be and search further for the next one. So let's say they check how the market behaved on the last 20 to 30 years when, for example, NFP, non-farm payrolls, were published. And if it will turn out that in, for example, 80% of time the dollar was up, they will try to go long on the next publications of this data. But bear in mind that this is just a hypothetical situation, just to give you an example. And the approach was simple. He didn't care why it is happening, he cared only that it was happening and that he could use it to his advantage. So you could say he was searching for some anomalies that are happening regularly. Next strategy is searching for reversions, or rather trying to predict them. This method was described in the book about Jim Simons called The Man Who Solved the Market by Gregory Zuckerman. and this method was predicting a mean reversion. Basically, it is a kind of similar strategy to one I covered on this channel some time ago. The basis are that when some asset is traded on a price that is deviated from the average, then he will bet that the price will eventually go back to the standard range. For example, we have two prices of oil. Brent, which is traded in London, and WTI, the Western Texas Intermediate, which is a slightly different kind of oil and is traded in New York. And typically, Brent is slightly more expensive than the WTI. And the difference between the prices of those two is from $3 to $5 on average. So, when the spread gets bigger and is around, for example, $10, you can bet making an arbitrage trade that the price will eventually go back to $3 to $5 difference. And this is kind of, we could say, 100% accuracy trade or a guaranteed trade. If you check the prices of oil, you will see that the quote always gets back to the average spread. And basically, sort of this is the method which Jim Simmons in his Medallion Fund is using. Of course, most likely they do it on hundreds of different assets on which they spotted the same dependencies, and unlike us average traders, we could say, he has access to more sophisticated software and machines that can do very complex calculations and analyze millions of data sets. But, of course, it shouldn't discourage us to try and learn and eventually reach some higher level of complexity and precision in our data analysis. The two last points of Simmons' approach are this: switch off emotions and let the computer do the tests. So this is nothing new, to be honest, in terms of emotions, but maybe his way of viewing things may sound more reasonable for you. As we talked previously, he didn't care why those correlations happened. He just cared that they did, and that's all. He didn't dwell on it, he didn't wonder how it happened, what are the latest news, what some investors are saying on Bloomberg, and so on. He just cares to take advantage on this, and that's all. As for using machines, I think we also don't need to add much more. It is obvious that before you trade any strategy, you should test it on past data at least. And we have, for example, strategy testers on MetaTrader platform and on TradingView, for example, as well, where you can use automated scripts and EAs and test them on millions of data on various assets. And right now, you don't even have to know how to code those algorithms, because there is something, I don't know if you heard about it, called ChatGPT, who will do it for you for free. So you need to log into OpenAI, of course, website, and then go to ChatGPT and ask him to write code, for example, in MQL5, so that you could test it later in MetaTrader 5. It is simple. You need to be specific for the AI what you need, what, for example, indicators you want to use, and so on. In which language you want this to be written. Then you just copy the code, paste it in the MT5 EA creator, and then run it in the MetaTrader tester. So now I'm about to end this video. I hope you like this one, guys, because Jim Simmons is a very interesting person and his work as well. I think it is advisable for you to check, for example, books that describes his work, like the one I mentioned by Gregory Zuckerman. And okay, guys, that will be all from my side. Do check our other productions, and I'll see you in the next video. Take care and goodbye.